In Chapter 2, we are going to look at understanding basic economics. The economy is the sum total of all economic activity within a given region, from a single city to a whole country in the entire world. Economics is the study of how society uses its scarce resources to produce and distribute goods and services. Economics is roughly divided into small-scale perspective and a large-scale perspective. The study of economic behavior among consumers, businesses, and industries who collectively determine the quantity of goods and services demanded and supplied at different prices is termed microeconomics. The study of a country's larger economic issues, such as how firms compete, the effects of government policies, and how an economy maintains and allocates its scarce resources, is termed macroeconomics. Each society must deal with how its finite resources or factors of production should be used to satisfy society's needs. Factors of production include the following: natural resources, which are things that are useful in their natural state, such as land, forest, minerals, and water. Human resources are people, anyone from the company's presidents to grocery clerks who work to produce goods and services. Capital includes resources such as money, computers, machines, tools, and buildings that a business needs in order to produce goods and services. Entrepreneurship is the spirit of innovation, the initiative, and the willingness to take the risk involved in creating and operating new businesses. And finally, knowledge is the collective intelligence of an organization. Knowledge workers are employees whose primary contribution to their companies involve the acquisition, analysis, and application of information. In this slide, we will talk about scarcity and trade-offs. It's important to note that scarcity doesn't mean a shortage of a particular resource. Rather, it means that that resource has a finite supply. Scarcity is an important concept for two reasons. It creates competition for resources, and it forces trade-offs on the part of every participant in the economy. Second, given this scarcity of resources, consumers, companies, and governments are constantly forced to make these trade-offs, meaning they have to give up something to get something else. Economists have a name for the option you don't select when you make a trade-off. Opportunity cost refers to the value of the most appealing alternative from all of those that you didn't choose. In other words, opportunity cost is a way to measure the value of what you gave up when you pursued a different opportunity. For example, somebody who attends class on campus can look at the opportunity cost of choosing to attend classes on campus instead of taking online classes, as you guys have chosen to do. This slide shows the continuum of the economic systems that exist. On the left-hand side, we see the free market system, and on the right side, we have the planned system. The roles that individuals, businesses, and the government play in allocating a society's resources depends on the society's economic system, which is the basic set of rules for allocating resources to satisfy its citizens' needs. Economic systems are generally categorized as either the free market systems or the planned systems, although these are really theoretical extremes. Every economy exhibits aspects of both approaches. In a free market system, individuals and companies are largely free to decide what to produce, how to produce them, whom to sell to, and at what price to sell them. Capitalism and private enterprise are the terms most often used to describe the free market system. Again, this is one in which individuals own and operate the majority of businesses and where competition, supply, and demand determine which goods and services are produced. In practice, however, no economy is truly free in the sense that anyone can do whatever he or she wants to do. Mixed economies, particularly those with strong capitalist emphasis, offer opportunities for wealth creation, but usually attach an element of risk to the potential reward. The United States, although we have a capitalist foundation, is a mixed economy. In a planned system, governments largely control the allocation of resources and limit freedom of choice in order to accomplish government goals. The planned system that allows individuals the least degree of economic freedom is communism, which still exists in a few countries, most notably North Korea and China. Like communism, socialism involves a relatively high degree of government planning and some government ownership of capital resources. However, government involvement is focused on industries considered vital to the common welfare, such as transportation, utilities, medicine, steel, and communications. Private ownership is permitted in industries that are not considered vital, and in these areas, both business and individuals are allowed to benefit from their own efforts. Here, we look at nationalization versus privatization. Governments can change the structure of the economy by nationalizing. That is, when they assume ownership of selected companies, or in extreme cases, even entire industries. They also move in the opposite direction, privatizing services once performed by the government by allowing private businesses to perform them instead. In the United States, private companies now own or operate a number of highways, bridges, ports, prisons, and other infrastructure elements, providing services once provided by the government. The U.S. government nationalized airport security after September 11, 2001. This slide shows a supply and demand curve in which the supply line runs from lower left to upper right. The supply line begins with a $20 value on the y-axis and angles up to end at a $35 value. The quantity is depicted on the x-axis and runs horizontally from a quantity of 10 jeans to a quantity of 35 jeans. The demand curve runs from the lower right to the upper left, beginning at a price of 20 and ending at a price of 35. The demand curve graphs the quantities of products that buyers will purchase at various prices. The supply curve graphs the quantities that sellers will offer for sale regardless of demand at various prices. The equilibrium price, also known as the equilibrium point, is depicted by the E, and if you note, it is at $25 at a quantity of 20 jeans. The theory of supply and demand is the immediate driving force of the free market system. Demand refers to the amount of a good or service that consumers will buy at a given time at various prices. Supply refers to the quantities of good or services that producers will provide on a particular date at various prices. Simply put, demand refers to the behavior of buyers, whereas supply refers to the behavior of sellers. Both work together to impose a kind of order in the free market system. Now we are going to turn our attention to competition in the free market system. Competition is the situation in which two or more suppliers of a product are rivals in the pursuit of the same customers. The nature of competition varies widely by industry. In theory, the ideal type of competition is pure competition, which is characterized by three conditions: a marketplace of multiple buyers and sellers, a market or service with nearly identical features such as wheat or cotton, and low barriers of entry. At the other extreme is a monopoly. This is when there is only one supplier of a product in a given market, and that supplier is able to determine the price within regulatory limits. Examples might include cable service in a specific area or electric or gas service. In addition, Sirius XM radio was allowed to merge and become a monopoly. A market that is dominated by only a few suppliers cause a situation known as an oligopoly. Examples of oligopolies include Boeing and the Airbus industries, as well as automobile manufacturers. Most of the competition in advanced free market economies, such as the United States, is monopolistic competition. This occurs when there is a large number of sellers, none of which dominate the market, and they offer products that can be distinguished from competing products in at least some small way. Toothpaste, cosmetics, soft drinks, internet search engines, and restaurants are examples of products that can vary in the features each offer. The economy is always in a state of change depending on whether it is expanding or contracting in response to the combined efforts of such factors as technological breakthroughs, changes in investment patterns, shifts in customer attitudes, and world events. Fluctuations in the rate of growth that an economy experiences over a period of several years are known as the business cycles. Economic expansion occurs when the economy is growing and people are spending more money. Consumers purchase stimulate businesses to produce more goods and services, which in turn stimulates employment and wages, which then stimulates even more consumer purchases. Economic contraction occurs when such spending declines. Businesses cut back on production, employees are laid off, and the economy as a whole slows down. If economic contraction is severe, the nation may enter into a recession. A recession is defined as 2 consecutive quarters of decline in the gross domestic product, which is a basic measurement of a country's economic output. A deep and prolonged recession can be considered a depression. A depression does not have an official definition, but is generally considered to involve a catastrophic collapse of the financial markets. Recovery is the period during which income, employment, production, and spending rise. Unemployment is one of the most serious effects of economic contraction. The unemployment rate is the portion of the labor force, everyone over 16 who has or is looking for a job, currently without a job. Frictional unemployment is the natural flow of workers into and out of a job, such as when a person leaves one job without first lining up a new job. There is always some level of frictional unemployment in the economy. Structural unemployment results from mismatch between worker skills and current needs of employers. Structural unemployment is a never-ending concern as changes in the external environments of businesses make some skills obsolete and create new demand for new skills. Cyclical unemployment is caused by the economic fluctuations we just described previously. During the Great Depression of the 1930s, the U.S. national unemployment rate ran as high as 25%, but even in the worst recession since then, it hasn't yet risen much above 10%. And finally, seasonal unemployment reflects job subtractions and additions in industries that need different numbers of workers throughout the year. For instance, farms and orchards need more workers during harvest seasons. Accounting firms need more employees during the April income tax season, and retailers need more sales clerks during the holidays. There are 4 major areas in which government plays a role in the economy. An attempt to balance the interest of stakeholders and protect those who may be adversely affected by businesses, the U.S. federal government has established numerous regulatory agencies, and state and local governments may have additional agencies as well. Many of these agencies have the power to pass and enforce rules and regulations within their specific area of authority. Some ways that the government can get involved are listed here. They protect the stakeholders, they try to foster competition, They encourage innovation and economic development. Another way they can do so is through trying to stabilize and stimulate the economy. They do this through two methods. One is fiscal policy and the other is monetary policy. Monetary policy involves adjusting the nation's money supply, which is the amount of spendable money in the economy at any given time, and they do this by increasing or decreasing interest rates. Fiscal policy involves changes in the government's revenues and expenditures to stimulate a slow economy or dampen a growing economy that is in danger of overheating. The broadest measure of a nation's economic health is the gross domestic product, also known as GDP. The GDP measures a country's output, its production, distribution, and use of goods and services by computing the sum of all goods and services produced for final use in a country during a specific period, which is usually a year. The products may be produced by either domestic or foreign companies as long as the production takes place within a nation's boundaries. For example, sales from a Honda plant assembly in California would be included in the U.S. GDP, even though Honda is a Japanese company. GDP has largely replaced an earlier measurement called the Gross National Product, or GNP. GNP excludes the values of production from foreign-owned businesses within a nation's boundaries and includes receipts from the overseas operations of domestic companies. GNP considers who is responsible for production, while GDP considers where the production occurs.